71, 72 points right now, and holding a pretty steady after yesterday's a little painful kind of session which we had. Prasun Gajri is with us of HDFC Live. He's joining us to talk about what he makes of things. Prasun, it's a pleasure. Great to have you back. I think the last time we spoke at that point also broadly, you were expressing a little bit of apprehension and caution at the pace of the move. Now, the thing is, the pace has been so stupendous that 2 weeks out, I mean, if we spoke 2 weeks back, a fortnight later, things are a lot higher across the market. I mean, that's the state of affairs right now. So are you more apprehensive, more cautious, and have you done anything about it?
No, our view remains the same. So as I said last time also, it's not that we are bearish per se, but just a little bit cautious. So we are kind of balancing out our views on the market in a sense that we are exposed to some cyclical sectors. At the same time, we are taking some defensive bets in the portfolio. So we continue to go overweight on pharma, for example, and even IT. At the same time, we remain positive on sectors like cement, parts of auto, parts of banking, parts of capital goods. So therefore, it's more of a balanced approach. The reason we are cautious is we believe that at these valuations, any kind of a headwind would be detrimental to the market. So our view really hasn't changed, I think, and we also believe that this is a market which is more conducive for large caps at this point of time, given the run-up we have seen in mid caps. Even small caps are now almost are actually more expensive than large caps on an aggregate basis. So clearly, the call we are taking is that we do not want to be bearish on the market. Clearly, the momentum is there, the liquidity is there, the entire view that the economy will open up again and we'll see accelerated consumer spending opening up, positive news flow, etc. We are very well aware of that, and therefore there's no point being overly bearish on the market. Having said that, I think it's not a market where I'd want to be completely going the cyclical way and not really looking at some of these sectors which can probably offer a very good value from a 12-18 month perspective, even though they may not be the flavor of the season at this point of time. So it's a more of a balanced approach rather than saying we're bearish.
Prasun, morning, Rima here. So you don't see the possibility of a big shakeout in the markets, given where small cap valuations currently are. As you said, they're higher than large cap valuations. You're not seeing signs of froth building up in the broader markets?
Well, yes, I do believe there is some froth, but we have seen in the past that this can clearly overextend and this can continue for a while. So the only way I see a major correction happening is if this is a synchronized global kind of a correction, liquidity withdraws, and which can happen either because the pandemic has a third wave coming in India or something, which the probability at this point of time is very difficult to determine. Hopefully, it's very low. Any policy mistakes by the central banks or the governments anywhere in the world which are contrary to market expectations can lead to large corrections. So barring those events, I don't foresee a large correction in the market per se. Having said that, what can give you a double-digit return from here is also difficult to envisage, and therefore the view. So we are not really calling for a major market correction unless a global correction also comes through.
No, I mean, would you term a 7-10% correction par for the course? I mean, or are you saying even that is without a global event, it's kind of it's tough to envisage at this point, Prasun?
Yeah, 5 to 10% correction can happen anytime, but given the state of the market, my sense is that it will get bought into. So unless it's a large correction driven by some very fundamental factors, say inflation rising, central banks reacting, or a large degree of earnings cut starting to happen again. Barring that, don't see a big correction happening. Having said that, the volatility can definitely be there. 5-10% corrections can come in. But given the liquidity both domestic now, that is picking up. The retail participation is very good. The mutual fund flows have also become positive again. And the global flows continue. So in this environment, expecting a very sharp correction and a sustainable correction looks difficult, barring what I said, a global synchronized move in equities downwards driven by some policy decisions.
Okay, so that's the overall market view, Prasun. You said you're positive on autos. What are you playing? The two-wheelers, four-wheelers? Are you banking on the CV recovery?
So we are more positive on the four-wheeler space, to be honest, and selectively on the two-wheelers, but it's more inclined towards four-wheelers. That's where we're in the autos. We are also positive on some of the auto ancillaries at this point of time because they allow you to play across the spectrum. So yeah, that is the view we have. So idea is that as we see cyclical recovery, as we see demand coming back, we could again see positive surprises on the demand as we saw the last time around. So that is the bet on the auto side we are taking. But obviously, any of these bets comes with the same risk. Today, we really don't know whether the demand is going to be as strong as was seen in the end of last year when it was a huge amount of pent-up demand surprised everyone. So one will have to wait and watch, and therefore we are also remain a little bit cautious in terms of overexposing ourselves to some of these sectors. So we're taking a little bit of a more guarded approach than we would have taken probably 6 months back.
Prasun, just a hypothetical. I mean, if you were handed a sum of money with no compulsion that you have to be in the market, you have to be in stocks, or with the mandate that you can't stay in cash, right? I mean, how would you treat this new money? Would you? I mean, how would you remain? How much would you remain in cash, and how much would you be in the market?
No, I don't think I'll remain in cash. I'll be invested, and we believe we are long-term investors. Our view is both 3-5 years. So from that perspective, I would be invested. It's just that the sectoral choices may not necessarily be in line with what is working in the market at this point of time, but will be a little bit more long-term. But I don't think staying in cash is the best of ideas if you're an equity market investor. It doesn't work over the long term, in my view. And it's a very difficult call to really pinpoint when the markets are going to turn either way. So, and in any case, the cash returns are fairly low at this point of time, and fixed income returns are likely to deteriorate as we go forward because the view is that at some point of time, interest rates are going to start rising. So I would definitely remain invested, but will take calls in terms of where I want to be invested.
So, I mean, how would you sectorally? How would you structure sort of this new portfolio? Like I'm talking sectorally in equities.
Where we are today, to be honest. So we are. If you look at our current positioning, we remain overweight on IT and pharma. We believe the growth story is pretty much intact. Valuations are in pretty much okay given the context of the market. So that gives us a bit of a defensive bet on a more secular longer-term story. At the same time, we remain positive on the financials. We believe they're a great cyclical play at this point of time. We like cement and capital goods because that is another cyclical play as and when the economy starts recovering. I think that will do well again. So that is the way we are at this point of time, in a sense that we do not want to be overtly cyclical at this point of time, purely given the caution which I talked about. But at the same time, remain fully invested. And wherever the caution has to be exercised, be a little bit more defensive in the approach. I don't think I'll change anything from that, even if I get completely fresh.
Okay. Prasun, PSU banks have evinced a lot of interest, and even outside of State Bank of India. Anything that you find attractive?
Well, I will not want to comment on individual stocks. Frankly, within the PSU banking space, we would like to kind of stick only to SBI. I think the PSU banking space from a longer term perspective faces several challenges. I think the asset quality is still not completely out of the woods. The growth is a challenge. How strong are they on the technology side? It remains to be seen. And there are enough good bets on the private sector side, which are available at reasonable valuations, showing better growth, that I will not really want to venture too deep into the PSU banking space at this point of time, barring SBI, obviously, which has done very well over the last few years.
This housing finance space, we've seen a deal there and it's kind of lit a fire under some of these names. Any opportunities you see there, or you think they're fairly valued across?
No, there are specific opportunities. As I said, I will not comment on individual stocks, but within housing finance, again, there are opportunities, we believe, because again, it has a long runway of growth. Some of the companies which manage the balance sheets well look fairly attractive at this point of time. So that is another, and that is one space where at least the growth has not been too bad. So effectively, I think that is a place where we remain interested in, and time to time, whatever opportunities come through, we'll look at that.
Prasun, it's a pleasure speaking with you and getting in your thoughts. Thanks again for joining in. Stay safe. We'll slip into a very short break on that note. We'll come back with more on the markets.
Sona